It is a Thursday evening, February 1949. New York City. A man named Frank McNamara finishes his dinner at a Manhattan restaurant, reaches into his jacket pocket, and finds nothing. No cash. He had left his wallet in another suit. He has to call his wife to bring money to a restaurant in the middle of one of the most powerful cities on earth. He sits there and waits, humiliated. Most people would have forgotten about it by morning. Frank McNamara could not stop thinking. Within 14 months, he had invented something that would permanently alter the relationship between human beings and money. Something small enough to fit in a shirt pocket. Something powerful enough to control the financial behavior of more than 4 billion people on this planet. A piece of plastic, the size of a playing card. But what you are about to hear is not the story of a convenient payment method. This is the story of how a single lunch bill set off a chain of events that toppled savings cultures, restructured national economies, built the most sophisticated behavioral surveillance system in history, and quietly transferred trillions of dollars from ordinary people into the vaults of a handful of financial institutions that most of us cannot even name. The card did not just change how people pay, it changed who people are. Frank McNamara was not a banker. He ran a small finance company in New York that helped retailers offer installment plans to customers. He understood better than most that the psychology of buy now, pay later had a power that cash simply did not. After that dinner, McNamara sat down with his lawyer, Ralph Schneider, and pitched an idea. A card that could be used at multiple restaurants, charged to a central account, paid at the end of the month. Not a bank card, not a store card, a universal charge card. On February 28, 1950, exactly 1 year after that forgotten wallet, McNamara returned to the same restaurant. He finished his meal. He pulled out a small cardboard card bearing his name. The waiter accepted it. The bill was sent to a company McNamara and Schneider had incorporated days earlier. They called it Diners Club. The idea sounds obvious now. At the time, it was considered slightly absurd. Why would a restaurant trust a piece of cardboard? Why would a customer want yet another monthly bill? And yet, within 1 year, Diners Club had 42 participating restaurants in New York and 10,000 cardholders. Within 3 years, it was billing more than $1 million per month. What McNamara had understood, almost by accident, was something profound about human psychology. People spend more when they cannot feel the money leaving. The physical act of handing over cash creates a measurable sensation of loss. Economists would later call it the pain of paying. A card eliminates that sensation entirely, but Diners Club was not yet the machine that would reshape the world. Its cardholders were mostly business executives. Its use was limited to restaurants and travel. And crucially, it required full payment at the end of each month. There was no debt, no interest, no trap. That would come from a different direction entirely. September 1958. Fresno, California. Residents open their mailboxes and find something they did not request. A small blue and gold card from the Bank of America. Already activated, already bearing their name. Preloaded with a $500 credit limit. The bank had mailed 60,000 cards to Fresno residents without their consent. The man behind this decision was a Bank of America executive named Joseph Williams. His logic was cold and precise. You could not convince merchants to accept a card that nobody carried. You could not convince people to carry a card that no merchant would accept. So Williams bypassed the problem entirely. He flooded a city. The results were, by any measure, a catastrophe. Fraud was rampant from the first month. Criminals who received unsolicited cards used them immediately. The program lost more than $8 million in its first year. The board nearly shut it down. Williams was removed from the program, but the bank did not kill the card. Because buried inside the disaster was a number that no one could ignore. A significant portion of cardholders, people who had received a card they never asked for, were not paying their balance at the end of the month. They were carrying it forward, month after month. And on that carried balance, the bank was charging interest. The executives ran the numbers. The fraud losses, the delinquencies, the operational costs, all of it was manageable, profitable even, if enough customers kept revolving their debt. This was the moment everything changed. The credit card was redesigned, not as a convenience tool, as a debt engine. The minimum monthly payment, low enough to feel manageable, high enough to ensure the balance survived for months, sometimes years, became the central mechanism of the system. And the arithmetic underneath it was brutally simple. The longer a person carried a balance, the more they paid. The more they paid in interest, the more profitable they became. The ideal customer wasn't someone who paid in full. The ideal customer was someone who never quite managed to. By the mid-1960s, dozens of banks across the United States were issuing their own cards. But the market was fracturing. A card from a bank in Chicago was useless at a restaurant in Atlanta. The network problem McNamara had first confronted in 1949 had returned, larger and far more complicated. The solution came in 1966. Bank of America began licensing the Bank AmeriCard to banks across the country. And then, in 1970, the card was spun off into an independent organization that would, 11 years later, rename itself. The new name was Visa. At almost exactly the same time, a coalition of competing banks formed their own network. They called it Master Charge. In 1979, it became MasterCard. Two networks, thousands of banks, hundreds of millions of cards. The infrastructure of a new financial world was in place. Throughout the 1970s and 1980s, the credit card crossed borders with a speed that almost no financial product in history had matched. It arrived in Europe, in Latin America, in Asia. And everywhere it arrived, it carried the same set of assumptions about human behavior, assumptions that had been built into its architecture in Fresno, California in 1958. The assumption was simple. Given access to credit, most people would use more of it than they could comfortably repay. This was not a cynical guess. It was a measured fact. Research conducted throughout the 1970s consistently showed that people with credit cards spent between 12 and 18% more than people using cash for identical purchases. They tipped more in restaurants. They underestimated their own spending. And they consistently overestimated their ability to pay balances down quickly. The industry did not try to correct this behavior. The industry was built on it. Interest rates on credit card balances in the United States were frequently above 18% annually, at a time when savings account rates were a fraction of that. The spread between what banks paid to borrow money and what they charged cardholders was, by any historical standard, extraordinary. By 1980, total credit card debt in the United States had reached $55 billion. By 1990, $230 billion. By 2000, $680 billion. Behind these numbers were individual households. A factory worker in Ohio who used a card to repair his car in March and was still paying for it in October. A nurse in Texas who put her daughter's school supplies on a card in August and found the balance had grown, not shrunk, by December. A retired couple in Florida with 6 cards across 3 banks who could no longer clearly account for what they owed or why. These were not irresponsible people. They were people navigating a system that had been designed at a structural level to be navigated poorly. Every card transaction, from the beginning, generated a record: the merchant, the date, the amount, the time. These records were kept primarily for accounting and fraud detection. They were useful, but they were not yet valuable in the way they would become. In the 1990s, as computing power expanded and data storage became dramatically cheaper, banks began to understand something. Transaction histories were not just records of the past. They were maps of human behavior, predictive maps. A person who started buying antacids late at night, then home pregnancy tests, then prenatal vitamins. Their financial behavior told a story months before they had told anyone around them. A person who began purchasing locks, boxes, and storage materials and stopped buying groceries at restaurants was statistically likely to be going through a separation. This was not speculation. By the early 2000s, major card issuers were employing behavioral analysts, statisticians, and eventually machine learning systems to extract predictions from transaction data. The card had become, without most of its holders ever understanding this, one of the most sophisticated surveillance instruments ever built into daily life. The data was sold, aggregated, anonymized in name, but specific enough to be extraordinarily useful to insurance companies, employers, marketers, and political campaigns. A cardholder's spending pattern could predict health outcomes, employment stability, relationship status, and voting behavior, with a statistical accuracy that surprised even the researchers who built the models. By 2010, the global credit card industry was processing more than $26 trillion in transactions annually. The fees on those transactions, invisible fractions of a percent charged to merchants who built them into prices, were collectively one of the largest passive wealth transfers in the history of modern commerce. Every time someone used a card, they paid a fraction of a cent to a network, multiplied by billions of transactions, every day, every year, for decades. Today, there are more than 4 billion credit and debit cards in circulation worldwide. Visa and MasterCard process more than 250 billion transactions per year across their combined networks. Total global credit card debt sits at approximately $30 trillion. The average American household carrying credit card debt pays more than $1,000 per year in interest alone. In the United Kingdom, in Australia, in Canada, in Brazil, the proportions tell a similar story everywhere. The minimum payment, that tool invented in Fresno in 1958, remains the mechanism by which ordinary households stay in a permanent financial relationship with institutions that earn money specifically because those households do not escape it. None of this was inevitable. It was designed. Each decision, the minimum payment, the revolving balance, the high interest rate, the unsolicited mailing, was made by specific people in specific rooms in pursuit of a specific outcome. The rewards programs deserve particular attention. Introduced in the 1980s and refined throughout the 1990s, they represent perhaps the most elegant piece of behavioral engineering in the system's history. A cardholder who earns airline miles or cashback on every purchase is being paid, in a sense, to spend more. The reward is real, but the mathematics underneath it reveal the mechanism. Rewards programs are funded overwhelmingly by the interest and fees paid by cardholders who carry balances. The person who pays in full each month benefits from rewards subsidized by the person who cannot. Frank McNamara sold his share of Diners Club in 1952, less than 2 years after that first cardboard payment in a New York restaurant. He made a modest profit. He died in 1957, at the age of 40, before Visa existed, before the revolving balance had reshaped the savings behavior of entire nations, before anyone had calculated what that embarrassing dinner in 1949 had set in motion. He never saw the empire. The card in your wallet today, whatever color it is, whatever bank issued it, whatever network processes it, is the final form of something that began with a forgotten wallet and a humiliated man waiting for his wife. It is a remarkable object, convenient, fast, globally accepted, embedded in every layer of modern commerce. It is also a machine that for more than 60 years has been systematically extracting wealth from the people who use it most, while generating some of the most detailed behavioral data ever collected on human beings outside of wartime. History is full of inventions that solved one problem and quietly created several others. The wheel created roads, roads created armies, printing created literacy, literacy created propaganda. The credit card eliminated the inconvenience of cash, and in its place, it built a financial architecture from which billions of people have not yet found the exit. The dinner that night in 1949 ended. The bill it generated never did.